Here we go. Let's talk about the third item. Let's talk about accrued revenues. Alright, with accrued revenues, what's happening here is basically you've earned the money, but you haven't recorded the journal entry yet. Okay, so let's say you're mowing lawns, and you mowed lawns, or you had somebody mowing lawns, and it was June 30th. June 30th was a Saturday, the accountant's not in the office on the Saturday, so maybe it's Monday, and the accountant's going, oh, we earned that money in June, it's now July 2nd, I need to record that money in June though, because we actually earned it in June, right? That's the idea. You have to put the revenues in the period in which you earn them. So if the lawns were mowed on June 30th, they need to get recorded into June 30th. Okay, so here's going to be your journal entry. Nothing terribly complicated here, none of this back and forth stuff. Your journal entry is actually just going to simply be a debit. Okay, so if we're talking about June, well, let's say we're going to date it on June 30th, even though maybe it's actually July 2nd that we're sitting down at our desk to do this. But your debit is going to be maybe to accounts receivable for maybe cutting the lawns. You cut $1,000 worth of lawns on Saturday. You've got a debit of accounts receivable of $1,000 and a credit to revenue or fees earned of $1,000. That's it. The important thing is the fact that we're going to date this thing as of June 30th. Like I said, it may actually be something, oh, that's going to wipe it out. Well, there we go. It may be something like really July 2nd, but we're going to make this recorded on June 30th because they were receivables there was revenue that we actually earned in June. So you're accruing the revenue to the right period. Okay, that's kind of it for that piece of it. Let's talk about that's not pretty. Let's talk about accrued expenses. Accrued expenses. Let's say, for example, that it is December 31st, and we're trying to prepare year-end financial statements, okay? And there are some bills that you're not going to get until the month has already passed. An example of one of those bills might be utilities, all right? When are you going to get your electric bill for December? You're not going to get that bill until sometime in January. But the point is that you use the electricity in December, you need to record it in December because you need to put the expense in the right period during the time that you incurred the cost. Okay, so your journal entry for December 31st is going to probably be an estimate. You may not have the actual number, but that's fine. Better to have a number in there that may not be 100% accurate than to have no number in there at all. So you're going to have a debit to utilities expense, and you're going to estimate the amount. For us, we'll use X's. But the point is that this is being done for December. We're estimating the expense because we need to show the expense in December. So we've got a debit to utilities expense and a credit to utilities payable. You're not actually paying the utility out yet. You haven't even gotten the bill. But you're recording the expense in the right period. You're going to record it in December because it is a December expense, although you're not going to be getting the bill in the mail until January. And that's really the point of that there. All right. The third, okay, so we've done the major four of them. Let's do the fourth one. The last one that I want to talk about is depreciation. So here we go. Depreciation. Okay, depreciation is really about your fixed assets. We're not going to get into talking about depreciation too much right now because we're going to spend an entire chapter on it in the future. But just to get an idea of basically how it works, depreciation is how you show almost the devaluation of your fixed assets. If you think about that, a brand new building is not going to be worth the same thing in the first year as it is in the third year. Or a desk, if you buy a desk. A desk is not going to be worth the same thing in year 1 as it is in year 6. Or certainly a car. You guys know all about the devaluation of values of a car, right? The idea here is that assets lose their value over time, and what that's called is depreciation. You depreciate all of your tangible fixed assets, which means items you can touch, buildings, cars, desks, faxes, computers, anything like that. Those items are all depreciated. So one of the typical adjusting journal entries is to show the depreciation entries. Well, the depreciation journal entry is very easy. Depreciation journal entry is always the same. It's a debit to depreciation expense for some amount and a credit to a new account called accumulated depreciation of some amount. All right, so there's your journal entry. The difference is you might have accumulated depreciation auto, accumulated depreciation buildings, accumulated depreciation desks, all right, or office equipment rather. You would have accumulated depreciation, probably a dash in whatever account it is that you're dealing with here. Now let me give you the T account for let's say we're talking about a desk here. So let's say we have a desk that we paid $1,000 for, and we say it's going to be good for 10 years. Well, that desk is going to fall under office equipment. And we're going to have that desk here. Draw another T account right now. You're going to have the T account for office equipment. That desk cost you, like I said, $1,000. So you're going to have a debit to $1,000. Well, historical cost principle says, if you go back to Chapter 1, it says that you must keep an asset on the books for what you originally paid for it, right? So that equipment can never be touched, that desk can never be touched. But what you have is you've got this other account. And this other account is called accumulated depreciation. And just make sure I don't get rid of my line. You've got accumulated depreciation, office equipment. All right. Well, this is going to be where you show how the asset is losing its value over time. Now, if we said this asset is going to be good for $1,000 and it's good for 10 years, then you can say that it would be about $100 a year would be the depreciation on that asset. So, using the above journal entry, I'm not going to bother to draw the depreciation expense side. I'm just going to do the accumulated depreciation side. Here is your $100 of using up of that asset in year one. Right? $1,000, good for 10 years, it's $100 a year. Well, you'd have a debit to depreciation expense of $100 and a credit to accumulated depreciation. Here it is. Okay, so let's say at the end of year one, this is your journal entry. Well, at the end of year one, what you're basically saying is you're saying that that office equipment, that desk, is not worth $1,000 anymore. That desk is now worth something less because it has been used for a year. That desk is now worth $900. You look at these two assets together in order to come up with the valuation. So that $900 is also referred to as your net book value, NBV, you'll see, net book value, is that $900, is what the asset is worth to you now. And these two accounts that are right here, these two accounts have a name. When these two accounts work together, or rather they work against each other, one carries a debit balance, the other carries a credit balance, and they're looked at together. They're called Contra Accounts. All right, I'll let you read up a little bit on these, but I'm not going to, like I said, I'm not going to go into them in too much detail right now because you will cover them again in the future. All right, so there's these two accounts are called Contra Accounts. They work against each other and they are combined to come up with a value. All right, and that is your last type of adjusting journal entry. From this point, if you remember my original slide where we first started here, your very next step is now to prepare an adjusted trial balance, which you can do in your homework or you can see in the book. All right, that's really the end of the core concepts for Chapter 3.